As per a recent industry report, the mutual funds industry in India managed an amount of 22 lakh crores of investor money as of March 2020. Of this amount, 40% of the corpus was contributed by equity mutual funds. That is, mutual funds that invest in the asset class of equities as a underlying asset class. The interesting thing to note here is that 87% of the equity mutual funds were owned by individual investors. The numbers tell it all. Equity mutual funds is the most popular asset class among investors. And any guesses for why is that? Because they invest in the most exciting of all asset classes, the most complicated of all asset classes, that is equities or equity shares. If we do a quick recap of what exactly is an equity share, it is nothing but the fraction of your ownership of that particular company. If you own 1 lakh worth of shares of an equity like HDFC Bank, when you buy the share, you are owning a small fraction of the company, which is in proportion to the total number of shares of the company that have been issued. And in proportion to the fraction, you have a claim over the future earnings of the company. We studied in detail about equity shares when we did session 6 of module 1, and we also learned that apart from being the asset class which generated the maximum returns, it was also an asset class which came with the maximum risk and also the most complicated asset class because of the number of parameters that affect it on a day-to-day basis. Since equity as an asset class is extremely complicated, that is also a reason why you see a large participation from individual investors in equity mutual funds. When we as an investor do not understand how equity shares work, the best way to participate in them and to benefit from wealth creation by investing in equities is through equity mutual funds. Just like the other mutual funds, an equity mutual fund will collect money from investors who want to invest in the asset class of equity shares. So when we have our investors Arjun, Kabir and Imran who are investing in a mutual fund, which is an equity mutual fund, that particular fund is going to park all the money they collect from the various investors into equities as an asset class. And as the returns are generated, the fund manager will take his fee for managing the fund on your behalf, and the balance returns come back to you as an investor in the form of a growth in the net asset value of the equity mutual fund. The biggest benefit of investing in an equity mutual fund is it helps you diversify across various companies with a small amount of investment. And if you recollect our session 6 of equities, we talked about the fact that equities are exposed to both systematic risk and unsystematic risk. And the unsystematic risk, which is very particular to a company or particular to a certain industry, can completely be eliminated by diversifying your portfolio holding of equities. And the best way to diversify is to hold an equity mutual fund, because when you give your money to an equity mutual fund, they would be investing the money into a basket of stocks, and that allows you to diversify your holding and completely eliminate your unsystematic risk. This is one of the ways you can manage your risk of investing in equities. Either hold a basket of stocks directly, individually in your Demat account. If you cannot do that for logistics reasons, or if you cannot do that because you do not understand equities as an asset class, then you move on to equity mutual funds to help you achieve these objectives. Just like equity shares, investing in equity mutual funds is the preferred route when you are investing for your long-term goals, because when you invest in equities for a long period of time, it helps you manage the risk that you're exposed to when investing in equities as an asset class. When you want to invest in an equity mutual fund, you have a lot of options available in terms of types of funds and the kind of industries and companies they invest in, which gives you a choice of picking those funds which are best suited for your risk appetite. And just like equity shares, equity mutual funds also have market risk because they invest in the underlying equity shares which have market risk. And if for some reason the stock market were to fall, your holdings also will see a fall in returns, because equities as an asset class is always going to be exposed to market risk. If you look at the various types of equity mutual funds as categorized by SEBI, there are two major ways in which the mutual funds are categorized. One is based on their market capitalization, and second, based on other than market capitalization. Now, when we look at equity mutual funds based on their market capitalization, you have large cap funds, you have large and mid cap funds, you have multi cap funds, you have mid cap funds, and then you have small cap funds. Again, you go back to our session 6 of module 1, we had studied about the various capitalization of stocks as large, mid and small. These funds basically are drawn from those capitalizations. The non-market based capitalizations consist of ELSS funds, or which are known as tax saving funds, value based funds, focused funds, dividend yield fund, thematic fund or industry specific funds, and lastly the contra fund. If you recollect, we had classified companies as large, mid and small caps based on the size of the company. And to ensure some standardization in this classification, SEBI has defined that the top 100 largest companies by their market capitalization, or what we mean is by their size, will classify as large cap companies. The 101st to the 250th company would be classified as a mid cap company, and all companies after the 250th company will be classified as small cap companies. And going by this classification, Reliance Industries, based on their market cap of 14.53 lakhs, is a large cap company. Bata India gets classified as a mid cap company, whereas PVR Cinemas falls under the category of a small cap company. Now, while equity as an asset class is risky, within equities also we can have a gradient of risk. If you were to plot large cap, mid cap and small cap companies, the large cap companies are considered to be the least riskiest within equity as an asset class, whereas mid cap companies are a little more risky and the small cap companies are the riskiest ones. And again, the more risky the investment, higher is the expected returns from investing in these companies. Now, this does not mean that when you invest in a large cap company, there is no risk or there is very little risk. Equity as an asset class carries with it high risk, high returns. But within equities, we are able to segregate between large, mid and small cap companies so that there is a further detailing to how much risk you are ready to take as an investor. Again, if you go back to the history and see, it is not uncommon to see even a large cap company fall by 30% in a financial year or give you a 50% return in a financial year. But having said that, relatively they are of a lesser risk compared to a small cap company. Keeping that in mind, let's look at some of the large cap, mid cap and small cap mutual funds. If we take an example of HDFC Top 100 Mutual Fund, which falls under the category of large cap mutual funds, it has given a return of 7% in the last 10 years as of 9th November 2020. If you look at the portfolio of the mutual fund, it is investing more than 92% of its corpus into large cap stocks and the balance into mid cap stocks. It held a total of 55 stocks, of which the biggest holdings were Infosys, ICICI Bank, HDFC Bank and Reliance Industries, which are all large cap companies. Next, if you look at DSP Mid Cap Fund, it has given a return of 12% in the last 10 years. And if you look at its portfolio holding, it consists of almost 60% of its investments into mid cap stocks, about 12% into large cap stocks and about 13% into small cap stocks. It held a total portfolio of 45 stocks and had investments in a number of mid-cap stocks as its top holding. One reason why a lot of mid-cap fund hold a certain amount of large-cap companies is it gives them the liquidity to immediately sell these large companies and convert their holdings into cash in case they have to meet certain redemption pressures. If you look at a small-cap fund in SPI Small Cap, it has given a return of 17.9% in the last 10 years. And if you look at its portfolio, its major holding is in small cap stocks and the balance into mid cap and the large cap stocks. One thing, if you have noticed across the risk meter of all these three funds, all of them are categorized as moderately high, right? So because all of them belong to the equity category of mutual funds, their categorization is moderately high. But within these equity mutual funds, the small cap funds are of a much higher risk, because of which they are able to give you much higher returns compared to the large cap funds. If we summarize the risk across these mutual funds in a single table for you to understand, you can see that HDFC Top 100 Fund is a large cap fund, whereas DSP Mid Cap Fund invests largely in mid caps companies, and SBI Small Cap Fund invests largely in small cap companies. What is new in this particular categorization is the style of investing. If you look at the style of investing below, you have value, blend and growth. Now, what do we mean by value-based investing or growth-based investing? Growth-based investing and value investing can be considered as two different schools of investing or two different thoughts of approaching the equity markets. The school of investing that follows growth-based investing is looking for those companies which are growing faster than the market or growing faster than others. So obviously a company which is growing faster than its industry is expected to generate higher profits, and because of the fact that they're growing faster than others or faster than competition, they would come at a premium valuation to the other companies. Now the school of investing which follows the growth investing style would be happy to pay that premium and invest in those companies which are growing faster than the market. Whereas the school of investing that follows the value-based investment style is basically looking for stocks that are undervalued for many reasons. Right? So when you do your analysis as an investor, you may think that the potential for a company is much higher, and for some reason the market is not assigning the value to the stock that the particular stock should have, because of which that particular stock is actually undervalued. And because it is undervalued, it allows you or gives you an opportunity to buy the stock at the lower value, and you wait for the stock to realize its value, and that's when you make your profit. To give you examples of funds who follow these investing style, a DSP Mid Cap Fund or an HDFC Top 100 Fund follows the growth style of investing, whereas an ICICI Pru Discovery Fund or an IDFC Sterling Fund, these follow the value style of investing. And when you look at the box, when it talks about a blend of both, that means it is a mix of both value-based as well as growth investing. The fund manager is not following a single school of thought. He's using the top picks from both the school of thoughts. Another categorization of funds that we've seen as per the SEBI category is a multi-cap fund. As the name implies, a multi-cap fund is not bound to a particular market capitalization. The fund manager is free to pick stocks from the entire market and create a diversified portfolio. He is not bound to only invest in a certain large cap or a mid cap stock. He goes around different market capitalizations and looks for those stocks where he finds opportunities. To take an example of a multi-cap fund, if you look at the Kotak Standard Multi-Cap Fund, it has given you a return of approximately 15+% in the last 10 years. If you look at its portfolio, it has a larger holding of large cap stocks and then followed by mid and small cap stocks. Now in November 2020, the fund manager would have a view that large cap stocks are expected to give more returns, and hence he would be holding a larger amount of these large cap companies, and he's free to move to small cap or mid cap companies when he thinks there is better returns in that. If you were to place our multi-cap mutual funds within our risk return expectation matrix, it is expected that a multi-cap mutual fund should give you returns higher than a large cap mutual fund but lower than a small cap fund, and the same with the risk. The risk of a multi-cap fund would be higher than a large cap mutual fund but lesser than a pure small or a mid cap mutual fund. While categorization of funds based on their size is pretty straightforward, let's look at some of the ways in which equity mutual funds are categorized based on the non-capitalization factors or based on factors which are not related to the size of the stocks those funds invest in. The first one is the ELSS funds, or what is known as the tax saving funds. ELSS stands for equity linked saving schemes, which are funds. If you were to invest your money in, you will qualify for a tax benefit under Section 80C of the Income Tax Act. Now, this particular fund comes with a lock-in of 3 years. That means once you put your money, it's locked in for 3 years, because the government wants to encourage you to put your money into equity funds, and the lock-in is trying to force you to stay invested for a long period of time, and they give you a tax benefit for investing in such a fund. Another kind of fund which is not based on its size is called a focused fund. A focused fund is basically a mutual fund which will not invest across 70, 80 or more number of stocks, will rather try to make money for you by having a very concentrated portfolio of stocks which does not exceed 30 stocks for that particular fund. Another category of equity mutual funds is the sectoral or thematic funds, which are funds that invest in companies of a particular industry. For example, if you take up a pharma mutual fund, it will invest in only companies which belong to the pharma sector. Or a thematic fund which invests in a particular theme. The theme can be infrastructure, the theme can be the India growth story, the theme can be investing in those companies which will benefit from the consumerism which is taking over the India market today. So the sectoral or thematic fund basically tries to make money from investing in either a theme or in a particular sector. If we take an example of an Axis mutual fund, which is a focused fund, as of October 2020, it held a portfolio of 23 stocks. And the reason being, it is a focused fund, so it wants to follow a strategy of holding a tight portfolio of well-researched stocks and try to make money from having a very concentrated portfolio. The returns which this fund has given over the last 7 years is about 14%. An example of a sectoral mutual fund would be SBI Banking and Financial Services Fund, which invests in companies belonging to a particular sector, which is either the banking sector and the financial services sector. So here it is very clear that the focus of this fund is a particular sector. Whereas if you take an example of a thematic fund, which is Aditya Birla Sun Life Manufacturing Equity Fund, this is a fund which is going to invest in multiple companies which in any way can benefit from the growth of the manufacturing sector in the country. So when you look at these categories of mutual funds, they basically add a flavor to your investing strategy. If you were to look at a focused fund is trying to hold a concentrated portfolio so that when those stocks do well, you get that multiplier effect in the overall mutual fund that you hold. Similarly, when you look at a sectoral fund, it allows you to take exposure just to the pharma sector or just to the banking sector. Whichever sector you're bullish on at a particular point in time, you can look at taking exposure to that sector via this mutual fund. And a category like ELSS, it allows you to take the tax benefit. It works like any multi-cap fund, but it comes with the tax benefit and the lock-in of 3 years, which is not associated with any of the other mutual fund categories we've talked about. Talking about taxation, equity mutual funds are taxed in the same manner equity stocks are taxed. Just like equity stocks, we can earn 2 streams of income when we invest in equity mutual fund. One is in the form of appreciation of the value of the fund, and second is in the form of dividends that we earn from the mutual fund. Just like equity shares, the dividend that we earn from an equity mutual fund is added to our income and is taxed as per the slab rate, whereas the appreciation in the value of the mutual fund is segregated into short-term and long-term. If I hold a particular mutual fund for less than 1 year, it becomes a short-term capital gain for me as an investor. And if I hold the fund for more than 12 months, it becomes a long-term capital gain, which is taxed at 10% when my capital gain earnings exceed 1 lakh. So the way I am taxed in terms of an equity mutual fund is very similar to my taxation for an equity share. To wrap up this session for you, equity mutual funds allow you to attain diversification by investing in a single mutual fund, which in turn invests in multiple stocks, which can be across the size of those stocks. Investing in equity mutual funds is the best way to plan for your long-term goals, which we will talk about in detail when we start the module 3 of our session. And finally, equity mutual funds come with a lot of flavors which allow you to choose funds which are best suited for your investment strategy and create wealth in the long term. Before we move on to the asset class of gold, in the next session we will talk about ETFs and index funds.